Starting next year, high earners making more than $145,000 per year are going to lose a major tax break. Uncle Sam just closed a very popular retirement savings perk, and it may force you to start putting money into a Roth 401k. So today I'm going to break down exactly what's changing, who it impacts, and how you can prepare. First, my name is Kevin Lum. I'm a certified financial planner, and this channel is dedicated to helping 1 million people retire without worry. For years, catch-up contributions have been one of the best tools for people in their 50s and their 60s to turbocharge their retirement savings. Often, after years of supporting burgeoning life expenses and kids and all the other things that take up money, people begin to realize in their late 40s and early 50s that they need to get serious about saving or retirement. And thankfully, the government provided a tax efficient way to save for retirement and also to defer taxes. It's called a catch-up contribution. In 2025, you can contribute $23,500 to your 401k. And if you're age 50 or older, you get an additional $7,500 a year in catch-up contributions. Even better, if you're between the ages of 60 and 63, there's a special super catch-up, allowing your total catch-up contribution to be $11,250. But thanks to new IRS rules tied to the Secure Act 2.0, higher earners, or those earning over $145,000 a year, will face some new restrictions. If you made more than $145,000 in wages last year at your employer, your catch-up contribution must go into a Roth 401k. That means no more upfront tax deductions. You'll be forced to pay taxes today, but you will be able to take the money out later tax-free. Essentially, the government is forcing you to make a Roth 401k contribution. I believe there's a silver lining to this situation because way more people will now begin thinking about using Roth accounts. I think Roth IRAs and Roth 401ks are still incredibly underused tools when planning for retirement. So let me give you an example how this could impact you. So let's say you're 60 years old and you're in the 35% tax bracket, and you are taking advantage of the full $11,250 in super catch-up contributions. It could cost you almost $4,000 in tax deductions, and it can have a ripple effect. It can increase your adjusted gross income. It could phase you out of other tax breaks, and it could even push you into a higher tax bracket. But here's where it gets even messier, because not only could you have to pay more in taxes and not be able to receive as big a tax deduction, but not all 401k plans offer a Roth option. Fidelity says 95% of its plans now offer a Roth 401k, and that is up from just 73% 2 years ago. So it's been a huge increase in the number of plans offering 401ks, and Vanguard says that 86% of their plans have Roth 401ks. But that means that some workers still don't have access to a Roth 401k. And if your employer doesn't offer a Roth 401k and you're a high earner, as of now, you won't be able to make a catch-up contribution at all. And so that could be a loss for people trying to max savings late in their career. Now, one other item I should mention is that, and it's important to note that the income threshold, so that 145,000, is based on your prior year's wages from your employer. Now, it's indexed for inflation, so by 2026, it'll be closer to $150,000 a year. But again, it is based on your prior year's earnings. Now, there are a few weird quirks. For example, if you have 2 jobs, the rule applies separately to each employer. So the threshold separately applies to each person you work for. Also, new employees get a free pass in their first year since the wage limit looks back to the previous year at the same employer, which is kind of an interesting quirk. And then finally, the other kind of interesting quirk is that the Roth catch-up mandate doesn't apply to high-earning self-employed individuals who don't receive traditional wages. They can continue making pre-tax catch-up contributions. Now, the truth is, most workers like the upfront tax break of the traditional 401k contributions. According to a study by Vanguard, they said that of the people who have access to a Roth 401k, which is now most people, only 18% of people take advantage of it. I think it is one of the more underutilized tools because the Roth has some incredible benefits, right? You pay tax today, but the withdrawals in your retirement are going to be tax free. And if you use this to be your more aggressive bucket, it can be a really powerful tool because you're able to build a tax free bucket of money for later in your retirement. And many high earners who are later in their career, who are at the point of the catch up contributions, they've already put too much money into a pre tax account, creating a tax bomb once their retired minimum distributions hit at some point in the future. I see this all the time. People come to me and they have this massive amount of money in their tax deferred account and they're still piling more money into it. And we're never going to be able to get that money out in a tax efficient manner. And so some high earners, right, they should be forced into a 401k or putting their money into a taxable brokerage account because they already have enough money in a tax deferred account and they're going to have a tax problem down the road. So while this change feels like a tax hike to some people, for many people, I think it could be a blessing in disguise. So here are a few proactive tips that you can take immediately. First, check and see if your 401k plan has a Roth 401k. And if not, push your HR team to add one right away, or you could be locked out of the catch-ups. Second, run your numbers, whether this applies to you or not, because paying tax today might sting, but it could help you avoid paying taxes later in retirement. And if you want some numbers to run the software, I will put a link in the description, or you can scan this QR code to try out the same software that we use with clients, and you can use it for free for 30 days. Just go ahead and click in that link or use the QR code and you can get 90-day trial to that software. And then the third step is consider balance. One of the things I think it's really important is being thoughtful about where you're putting your money. Don't just think about putting everything in a pre-tax account or everything in a Roth. Also consider your taxable brokerage account. I have never had anybody say to me, I wish I had saved less money in my brokerage account. So don't discount using your brokerage account. It's not just about a traditional IRA and a Roth IRA or a traditional 401k and a Roth 401k, but you should also consider, actually, should I just be putting more money into my brokerage account as I prepare for retirement? Fourth, don't just think about the Roth 401k in relationship to your catch-up contributions. For some high earners, it might make sense to contribute more money to your Roth 401k in addition to just the catch-up contribution. So those are just 4 quick steps that you can begin taking before this rule goes into effect. Begin thinking like, how much do I want to put in a Roth 401k, or do I want to put money into a brokerage account? And does my company have a Roth 401k? And make sure you begin pressuring them right away so you can get that set up. This is the first time the tax code has ever mandated Roth 401k contributions. And I think it's kind of a big deal. In fact, I think overall, it could be a positive. It can be a headache in the short term. It's going to feel bad for some people to have to pay a bit more tax, right? Because we love saving taxes today. But I think this could mean that more people are going to become aware of Roth 401ks and more people are going to begin taking advantage of it. And I think in the long run, it's going to set many people up for a much more tax efficient retirement. Now, my guess is the federal government needs more revenue today, so they're trying to reduce the reductions you can take today. But for you, in reality, being forced to make that Roth 401k contribution might not be the worst thing. And most importantly is it's going to raise awareness about Roth 401ks. And I think many more people are going to start using this incredible vehicle that too few people take advantage of. Again, if you remember from the Vanguard study, only 18% of people who have access to a Roth 401k take advantage of it. So hopefully this rule change is going to raise awareness about Roth 401ks, because I believe that many people today who are contributing to a traditional 401k should in fact be contributing to a Roth 401k. And some people who have a bunch of money in a tax deferred account should consider potentially doing Roth conversions today. And if you are interested in that, you want to learn more about that or why maybe you should, I have an entire video where I talk about that, and you can watch that now.